Hi everyone, Greg Martin, the Entrepreneur's Banker here, and this week we're continuing the Selling Your Business 360, a full circle view of your exit series, and we're talking with Eric Doyal, founder and managing partner of Briarwood Partners, a private equity firm in Houston, Texas. Now, last time we talked with an entrepreneur that sold their business to a private equity firm, which is a really unique way of exiting. This week, we're looking at the other side of that coin and understanding what a private equity buyer is actually looking for when they're looking at acquiring part or all of your company. I hope that you connect with Eric. If you're not connected on LinkedIn, he is an amazing resource and someone that I feel wants to bring true value to entrepreneurs. So I hope that you enjoy this time. I hope you connect with Eric, and thank you so much for joining us today.
Eric, thank you so much for joining us. Really look forward to today. Tell us a little bit about yourself, your background, and a little bit about Briarwood Partners.
Awesome. Yeah, thanks, Greg, for having us. Briarwood was started in 2020, launched with one of my best buddies, Barry Kessler, a former A&M undergrad as well. We invest in businesses along the Gulf Coast, Texas, I-10 corridor, predominantly industrial waste, transportation, and infrastructure service companies in the $1 to $10 million in cash flow range. We typically partner with entrepreneurs, so we never want to own more than 60 to 80% of the company. We want to invest in those businesses, grow the value of those businesses, and then sell them for more than what we pay. So my background is 14 years in private equity. My co-founder's background, Barry Kessler, spent 14 years in investment banking. He's an engineer by trade. I'm a finance guy by trade. So very different perspectives on how we think through opportunities, but complementary.
So Eric, I find it interesting that your model with Briarwood Partners is to really partner with entrepreneurs. So you're not looking to be that strategic buyer that kind of comes in and just brings a bunch of companies together and then sells it. You want to work with entrepreneurs in the long run. Is that unique in the private equity space, or is that pretty common?
It's a bit unique in that we'll never own 100% of the company. And if we're in the business, running the business day to day, it means something has gone materially wrong. We don't want to be running the business. We want to find partners that have the same or really similar core values to ours. We want to let them take some chips off the table, but we want them to own a still material portion of the company going forward. And we want them to be financially aligned with Briarwood Partners in that we want to grow the value of the business over time and then sell it to a larger private equity firm or to a strategic buyer.
Okay, so it's having that communication up front with the type of private equity company or private equity firm that an entrepreneur could sell to is really, really critical. Knowing, hey, I want to clear some chips. I want to cash out a little bit for my hard work, but I don't want to give up.
Chips off the table. I want to get off the personal guarantee with Greg, but I still want to own 20, 30, 40% of the company because I believe in the growth prospects. But I need to find a partner that has alignment with core values, but also in the vision of how we can grow the enterprise value, the value of the business over time. And time is typically in my business 3 to 5 years. But in our transactions, we take the view that everything we buy, we're going to own it forever. And that changes how we make decisions with respect to the strategic value enhancement of the company, of the companies that we partner with over time.
So Eric, what is you talked some of the benefits of partnering or selling to a private equity firm. What is, other than the cash, what does a private equity firm really bring? Like, I mean, the team, and I'm thinking like the team that you assemble to really provide support for that entrepreneur. Can you dig into that a little bit?
Yeah, I think we're pretty unique at Briarwood in that my experience has been predominantly private equity investing. Barry, one of my partners and a co-founder of Briarwood, has been on the sell side as an investment banker. But again, his background is engineering by trade. And then we have 2 other partners who have spent the majority of their careers running companies. So we bring a finance guy, an engineer, and then 2 operators to the table. So we're able to provide resources beyond just capital strategic advice, coaching, mentorship to the table, which is pretty unique given that we're playing in this lower middle market space. And we have coverage. One of our partners spends the majority of his time in California. The other is in New Jersey most of the year. So we have coverage across the United States and actually internationally as well, given Mike and Alex's experience in operating international businesses. Given our size, we bring a lot to the table in terms of skills, capital, and just resources.
So you talked about how important it is to have alignment between the entrepreneur and the private equity firm, and I'm assuming that the industries that you decided to focus on with Briarwood Partners is because you have historical experience in that and you're very comfortable in those industries. And so my question is, if you were an entrepreneur that is looking to maybe partner with a private equity firm, but haven't talked to anybody before or anything like that, how do I interview a private equity firm to know that culture is aligned, vision's aligned, and that industry experience is aligned?
Yeah, I'd spend, and we do this actually, the most important diligence that we do is diligence on our partners. I've been in deals where you're in good industries, but you have not great management teams and those deals don't work. I've also been in deals where industries may be suboptimal, but we've got a great team and they figure it out. And those deals, you don't lose money on those deals. So the people aspect of what we do is so critical, both from my perspective and from the seller's perspective, who's ultimately our partner. I'd spend, and we spend a lot of time outside of the business with the entrepreneur partner, and they spend a lot of time with us outside of the business. I'd also encourage the entrepreneur to reach out to other entrepreneurs that have partnered with the firm that they're contemplating partnering with, and ask them to provide a list of every CEO that they've ever worked with, and good and bad. And if they're not willing to do that, then that reveals a lot about
a little bit of a red flag, even the bad ones. And that's really, I mean, I get it. I don't want to tell a prospect, hey, here's a relationship that I had that maybe didn't go perfect.
Right.
But to have that open and honesty of, hey, it happens. We're all human.
That's right.
You know, so
when you look at, so we lead with our core values at Briarwood: hard work, integrity, humility, a bias for action, and fun. And that integrity piece should still come through even in those experiences where maybe the deal didn't work. I'm hopeful that the feedback from our partners would be that they did the right thing. It didn't work, but they did the right thing. They were honest.
Yeah. And I think that is so critical. As I've gone through this series, what I've heard over and over again is there's definitely the financial part of it, and we'll talk about that in a second. But having that soft skill, whether it be the emotions of the transaction, or in a case like with working with someone like you, to be able to have a partner to continue growth. I mean, you've got to align yourself up correct, and that's so important.
It truly is. It's a marriage. It's a business marriage. And the bedrock, the foundation of that relationship has to be trust. So we spend a lot of time throughout the relationship, but especially in the beginning of that relationship, just getting to know one another, right? Personally, not necessarily business wise, but just personally. What are the blind spots? What are the strengths of the individuals, both from our perspective and from theirs? And then how do we find a way to complement each other? The first 6 to 12 months after a transaction is consummated, it is in our view really, really critical to the long-term relationship between us and our partner. And so we just spend a lot of time together, both inside the business and also outside the business. Getting to know spouses actually is really important, and getting to know their family is important to us, because we truly are entering into a business marriage.
I love that you say that, because that this is such a unique situation. So you're going into a business marriage, and so you've got an entrepreneur and a private equity firm, and they kind of see each other from across the bar, and it's like, hey, you're kind of good looking. Let's date a little bit. So then you start dating, and then you start fighting,
Yep.
to be able to kind of go through that and go through the evaluation. I'm going to ask a couple specific questions about that in a second. But then at the end of the fight, you kiss and make up, and now we're married.
And now you're partners, right? So you're negotiating the transaction through the letter of intent period, all the way up through the consummation of the transaction, deal funds, and then all of a sudden you're on the same side of the table, right? You're partners. So it's an interesting dynamic and a shift that occurs after the transaction has been completed.
And so in your experience talking with entrepreneurs, maybe this is the first time that they've dealt with a partner like you. I mean, do you talk about that and just be really upfront and honest to be like, okay, this due diligence period, as we're going through, we've initiated and say, okay, here's what we think this 60% is worth. And then we're actually going to dig into the books and start exploring different risks that are in the business, whether it be a concentration risk or a management risk or some type of environmental risk or a bunch of other things. And obviously risk impacts value. And so I may say it's worth this, but after looking at everything, I may, come off 20% or more. And obviously the entrepreneur's like, what the hell? That's not what you promised.
We pride ourselves on not, in our business, that's called retrading on the transaction at the end of the deal. There are other private equity firms that are known to do that, but we try and transact on what we told the entrepreneur partner that we would do, because you never want to enter a new partnership with a, for lack of a better term, pissed off partner.
Yeah.
Right. So
and not trustworthy.
Right. But we also try and prepare the entrepreneur who's never gone through diligence for how painful diligence is going to be. They often have no idea. And diligence is brutal, right? It's a 90-day marathon. And they're oftentimes not prepared for that. So and not even just the documentation, providing financials, digging into environmental risks, insurance risks, customers, vendors, but the emotional toll it takes while you're still having to run a company is really, really hard. So one of the things we encourage entrepreneurs to do that we're going through diligence with is, one, hire really good legal counsel who's done mergers and acquisition work before. And by the way,
in this industry,
in this industry, not a guy who's done, or gal who's done real estate stuff, right? Hire a true M&A attorney. And by the way, we provide them with a list of 5 attorneys that we've worked with in the past that are good, that they can interview if they don't know anybody. So that's one, hire really good talent on the legal side. And then also, we're going to come at you with a bunch of requests. You may want to think about hiring some additional resources on an hourly basis to help deliver on those requests. So again, the last thing you want to do is lose focus on the performance of the company as you're going through diligence, because that puts at risk the deal.
Yeah, if the company kind of goes down in profitability or whatever, I mean that there's a lot of reasons for that, but I can see from your side, okay, that means there's too much reliance on the current owner.
That's right.
To be able to do that. So do you work with, how do you work with brokers? Because I know some entrepreneurs hire brokers to market themselves and to come with you. So do you speak directly with the entrepreneur? Do you speak with a broker? Who's kind of the point of contact?
We leave that up to the broker. If the seller is represented, it's really important for us to maintain constructive relationships with the broker. And if they're comfortable with us interacting directly with the entrepreneur, we'll certainly, we prefer that. But if they're not comfortable, if they want to be involved and on the calls and in the meetings, then we're certainly open to that as well. It really is up to what the broker's desire is.
Gotcha.
And we try to be respectful of that.
So you talked about the due diligence period being a 90-day marathon. Is that a typical timeline? Because I've heard it, some horror stories of it stretching out a year, which has to be terrible. But 90 days seems relatively fast.
90 days is pretty typical in the COVID environment. In our last transaction, we got 120 days to get the deal done because it was tough to get meetings, candidly. That was in February of 21 when we closed. So we were going through Thanksgiving, Christmas, New Year's, and into 21. This was before vaccines were readily available as well. It was a challenge to get meetings. Now we're getting, and we got the deal done within 90 days. We're getting 90 days currently in letters of intent and exclusivity. And that's pretty typical in our space. What could trip that up? Underperformance of the business. We find something in diligence that raises red flags that we weren't aware of, or in our business, one of the most important pieces of diligence is what's called quality of earnings. So you as a seller represented to me as a buyer that I'm purchasing a certain amount of cash flow, right? Which is what I'm paying a multiple of. And we spend a lot of time diligencing whether or not what you've represented to us as the cash flows of the company are actually there. And that's where we spend an inordinate amount of time in the beginning of diligence, because what you don't want to do is spend a lot of legal dollars and then find out at the end of the day that what's been represented to you as the cash flows of the company are not real.
Wow. So I mean, that's where it's incumbent on having clean books that clearly delineate, every entrepreneur out there that runs a business has certain personal expenses that the business picks up. You as a strategic buyer, you're not necessarily looking to fund their country club membership.
Yeah, you don't get to run your personal expenses through the company once you sell a majority of the company to us.
That's right.
So in our business, that's called add backs or adjustments. The fewer add backs or adjustments that you have as a seller, the better, right? Not only from my perspective, but also I'm having to go and get a portion of the purchase financed by you, Greg, right? By a lender. And so as a lender, you're underwriting the cash flows just like I am. Now you look at it a little bit differently because you're getting the assets as well, but you're still relying upon the cash flows of the company to repay the loan that you're making to the business. You don't want to liquidate the assets just like I don't, right?
Yeah. Yep.
So it's very important to have confidence that the cash flows that you and I are both underwriting are real. And by the way, we recommend, and we do this once we invest in a business, business owners should consider getting financial audits annually and or reviewed financials, if nothing else. And that will do a couple things. One, will likely speed up the time it takes for our quality of earnings to be completed, which reduces the amount of time that it would take to transact. And it'll also give you, the bank, and me, the buyer, more confidence that, again, the cash flows that have been represented to us are real, because there's been an auditor in there annually reviewing the financial performance and the controls of the company.
And I think that's really important, because that auditor is a third party, independent. I have to check every single deposit. I have to check every single check that goes out to make sure that it's put in the right category. And so that we work through that. And I mean, quite frankly, that is an additional expense that a lot of entrepreneurs aren't used to, but it's a matter of saying, okay, this is an investment in you and what you want to do. If you don't want to do an audit, then you may not be able to sell to a strategic buyer like you. That may shrink the pool of potential buyers for their business.
It not only shrinks the pool, but it could reduce the value that buyer's willing to pay. So yes, it's an expense in the short run, but if I'm able to get another, call it in my business, half turn on EBITDA. So if I have a $5 million EBITDA business, if the buyer, because I have audited financials for the last 5 years, is willing to pay a half turn or $2.5 million more for the company, is it a big deal if I spend 20, 30 grand a year to capture that value? That's something you have to evaluate as an owner.
That sounds like a good investment to me, right. But I'm not an entrepreneur, and I'm not the one living that day to day.
Right.
That's right. So let's talk about valuation. It sounds like the primary driver in the industries that you guys work with it's a function of multiple of the earnings before interest, taxes, depreciation, the free cash flow. And I think that's adjusted, added back for some of the seller exceptions that you talked about.
Look at a couple metrics, right? And want to be careful not to conflate EBITDA, earnings before interest, taxes, depreciation, and amortization, with free cash flow, because they're not the same.
Mm-hmm.
Right? EBITDA less maintenance CapEx in my business is what we call free cash flow. So we're willing to pay a different multiple of free cash flow than we are of EBITDA, but we look at both of those numbers and assess what we're paying as a multiple of those numbers, and is that within the range of where companies in certain industries, geographies with this profile tend to trade. And that's how we arrive at a valuation of what we're willing to pay. And then it's a negotiation between us and the seller about what they're willing to sell for, what they think the company's worth. But in many instances, what they think the company's worth may not be what a buyer is willing to pay for that business, which is ultimately what the business is worth. It's what somebody else is going to pay for it.
So I find that really interesting. So you've got the EBITDA, and then obviously, you either have your capital that investors have brought into your firm, or if you get debt, you have to service that debt. Right. I mean, at the end of the day, you're interested in what, after everything is all paid, that's what right. Can my investors, what can the group have access to?
Free cash flow is really what we're focused on, because you have EBITDA, but then you've got to buy assets annually to maintain that cash flow. So you have maintenance CapEx, which reduces your EBITDA, right? The cash that the company generates. Plus, you've got to pay you, right? You've got to repay the debt. You got to amortize that debt, and you have to pay the interest cost on that debt. So after all that's paid for, what do you have left to be able to grow the business, right? And the governor on what we can pay for a company is how much leverage you can put on a business. Because for us to generate, our objective is to generate at least $3 for every dollar of equity that we invest in a transaction. Okay. Right? That's a win. For us to achieve that, we have to add leverage to the transaction. And how much leverage we can add to a balance sheet is a ceiling, a governor on how much we can ultimately pay for a business.
You only pay. So is that, so when I hear that, I'm thinking in my mind, the industries that you work in, I mean, they have some very expensive equipment. I mean, transportation trucks, waste management trucks. I mean, those are easily could be $500,000 a pop. And so if you have maybe an older fleet that's still churning out cash flow, so your EBITDA looks great, but that thing's, I'm gonna have to replace half the fleet in 3 years. That's severely going to impact what you as a strategic partner is going to be willing to pay.
100%. I'm looking at free cash flow, not EBITDA. If it's a capital intensive business, EBITDA doesn't matter. I mean, it matters, but it doesn't matter as much as free cash flow. Free cash flow is ultimately what you have after you've paid your employees, your vendors, for all your CapEx and the bank. Mm-hmm. Free cash flow is what you have left.
Yeah. So Eric, you and your team kind of come in, you provide some cash to the current owners, able to take some of that risk off of the table from their perspective, allow them to achieve some specific goals that they've got personally. You help provide structure and management and coaching and mentoring to be able to continue to make the business efficient with the stated goal of growing it and then potentially selling it, and hopefully selling it to some at a larger multiple, larger value down the road. So who takes the point on that part of the transaction? Okay, now we've grown it for 5 years and everybody agrees, yes, it's time to exit completely. You as the majority owner, do you run point on that?
Let me step back and say this. The first slide in our board deck is a slide that demonstrates how much free cash flow we need to add to achieve our investment return objectives, to achieve at least 3 times equity returns. And then we back into okay, how much revenue do we need to add to achieve that free cash flow expansion based upon some multiple that we believe we will get multiple of cash flow that we will get whenever we sell the company. Okay. We're constantly, every quarter, assessing where are we relative to where we need to get to. And once we are approaching our financial objective, it's time to sell, right? But it's not a surprise. It's a conversation that is ongoing throughout the investment life cycle or partnership, right? So we don't spring that on the entrepreneur, hey, by the way, it's time to sell. We're clearly focused on that objective throughout our investment period of a deal.
Which goes back to the first point that you said, is that you have to be aligned in not only how you are going to operate the business for the next couple of years, but what is the ultimate goal for everybody?
What's a win? You got to know. You got to know what does a win look like, and we're very clear up front. A win is achieving at least 3 times cash on cash equity returns for our investors and for you. And if that's not what a win looks like for you, Mr. Entrepreneur, then we're not the right partner.
That's right. Maybe they're dazzled by the fact of, I think it's really unique to be able to get a chunk of money and still be able to operate that business. But when you don't own that 100%, then maybe your eyes kind of start to wander, your attention span starts to wander, and so having a partner like you to be able to focus, be like, no, this is what we all talked about. We're moving forward together.
That's why, Greg, we never want to own more than 60 to 80% of the company, because in that instance, there is complete economic alignment between us and our partner if they still own 40% of the business. They're still highly incentive. In fact, we believe that if we're successful in most instances, their 40% that they rolled over with us should be worth more than the 60% that they sold to us if we're successful in our partnership.
I love that. I love that alignment of goals and alignment of wherever you're moving forward to.
Right.
So just one quick question as we're kind of start to wrap it down. I'm curious, the legal structure. I mean, your company buys into the existing entity. So you own 60 or 80% of the existing entity. It's not like you create a new company.
No. Typically, we will create a new entity, and that entity, we will fund equity and debt into that entity, into NewCo. NewCo will purchase the assets of the company that we're partnering with, the company that we're buying, in exchange for cash proceeds from NewCo. The assets will then be purchased by NewCo and sit in NewCo. That achieves 2 things for us, for the buyer. One, we get a basis step up for tax purposes. So we get to reappreciate those assets, right? From a tax perspective, that's meaningful.
Huge.
And we shed the liabilities or potentially unknown liabilities by not buying the stock from that entity.
Okay.
So it's a less risky transaction for us as a buyer, because we don't know as much about that business as the owner does.
It's been going on for 30 years, and there's a lot of potential liability that could be baked through that. So, but then the entrepreneur then has ownership in NewCo. Is that how the alignment is connected?
Typically, in exchange for the assets that NewCo is buying, NewCo will pay cash and give that entity shares in NewCo.
Okay, right? So the entrepreneur's entity is still in existence. So the entrepreneur owns the entity, which owns ownership in NewCo. NewCo owns all the assets of the former operating company.
That's correct. That's typically how we structure a transaction.
Gotcha. So what I heard from the buyer's side, from the seller side, is that since it is an asset purchase, they need to make sure that they're talking with their team, their attorneys, their insurance people, everything, to make sure that any potential liabilities don't creep up and, affect them.
Not just that, Greg, but maybe one of the most important things and important people that they need to be talking to is their tax folks. Because in a structure as I've just described, typically an entrepreneur will depreciate for tax purposes assets as fast as they can to reduce their tax liability.
Sure.
But typically in an asset purchase, as I've just described, that entrepreneur is going to have to pay recapture on the depreciation that they've accelerated. And they don't like that, and they may not be aware of that. So it's very important for the entrepreneur, for the seller to understand that they've deferred those taxes, but at some point you're going to have to pay them, right? And to understand that the tax implications of the transaction on the front end, to not be surprised as you approach closing.
Yeah, because that has got to be a terrible sticker shock to think that I'm getting $5 million. And then Uncle Sam says, congratulations, I am so proud of you for selling your assets. Now let's talk.
Yeah, Uncle Sam's going to get paid, right? Whether you defer it or you pay it, you don't accelerate the depreciation of those assets. They are going to get paid, and that's not a liability that I'm prepared to assume.
That's right. So Eric, you've really shed a lot of interesting light on the private equity's view of coming in and helping entrepreneurs. I think that I love the fact that the way that you and your partners have said we want to work together is to not just buy it in whole, but we want to support the entrepreneur. We want to empower them to grow this, and then together we're going to achieve a higher multiple sometime down the road.
Right.
If you could give one or two bits of advice to an entrepreneur who's thinking about selling, maybe selling in 3 to 5 years, what would that be?
It's a great question. When we're investing in a business, we ultimately have to think about the end. Who are the likely buyers? What are those likely buyers willing to pay more for with respect to my company? What do I need to do to be more attractive when I go to sell this business? And in fact, we on the front end develop a strategic plan that says, here are the most important 3 to 5 things that we need to do with this business, such that when we achieve those in the next 3 to 5 years, we will increase the probability that the likely pool of buyers will be willing to and able to pay more for the business than what we paid. Going through that process as an entrepreneur and reaching out to guys like you, guys like me, others who are in the industry, and purposefully investing in the business to execute on that strategic plan, that 3 to 5 year strategic plan, is something that I think a lot of entrepreneurs don't do or don't seek help to do in advance of preparing a business for a transaction. And if they did that, they would likely achieve more value.
Their end state.
For the business.
So is it normal for an entrepreneur to reach out to someone like you and be like, hey, I'm not ready to sell now, but I want to start developing a relationship, and maybe you can give some advice on what I need to do over the next 36 months?
100%. We're open to that. We are playing long ball. We hope that Briarwood is around for 20, 30, 40 years. And the most important thing that we do is invest in people. It's not trucks, it's not trailers, it's not businesses, it's people. We are happy to help provide advice, feedback, coaching, mentorship, and hopefully someday that leads to a transaction, but ultimately it's the right thing to do.
Right.
So we believe that over time, keep doing the right thing, attitude, how hard you work, how you treat people. You do those 3 things every single day, and success finds you. People want to work with you. They want you on their team. And that's what we're focused on doing every day.
Yep. Okay, so let's close it out. Remind me again of your key principles, your foundation, your values, and briefly tell me, why did you select those? When
I was thinking about starting Briarwood, which at the time it wasn't Briarwood, I started with a blank sheet of paper and I listed my personal core values. hard work, integrity, humility, a bias for action, and fun. And decided that I wanted to build an organization, a business, and a team around those core values. And then I went out and tried to source people that I knew and trusted had the same or really similar core values. And that's what we've done. And we want to find partners who want to partner with folks like us who have the same or really similar core values and who want to do life together with other folks like that.
Awesome. Well, Eric, thank you so much for your time. Thank you for allowing us to kind of, peek behind the curtain a little bit and see the wizard work his magic. I do want to make sure that it's really clear that any of the opinions or any of the discussions that Eric and I talked about today, these are our specific opinions and our personal thoughts. They do not represent our companies or affiliates or anything like that. So now that all the legal mumbo jumbo has been taken care of, but Eric, seriously, thank you so much for joining us. How can an entrepreneur reach out to you to connect with you and maybe learn a little bit more from you?
Yeah, go to briarwoodpartners.net, reach out to us, email us, text me, call me, completely open and would love to try and help anybody out there who needs help. And I'll end with this, Greg. You and I met at the Entrepreneurship Bootcamp for Veterans. To all those men and women who serve the country and are protecting us every day, that allow us to do what Greg and I do every day. Thank you. Appreciate you guys.
Amen. Couldn't have said it better. So thank you all so much for joining us. And we hope to join us next week when we continue our conversation about selling your business from a 360-degree view to be able to give a holistic approach. Until then, thanks.
I don't know about you, but that was so eye-opening for me personally. Like I said, I haven't really dealt with a lot of private equity companies in my professional background, and to be able to learn from Eric and to kind of peek behind the wizard's curtain, so to speak, on what a private equity firm actually looks like was so amazing. And I know that you got as much value out of it as I did. But the three things that really struck out to me were, number one, values. At the core, value is so important. Values and alignment, understanding what both sides understand what a win is. If you both understand what a win is, then you'll be able to work through the negotiations and kind of a little bit of that struggle that is the due diligence process together. Two, he talked about team. And last time, Corey talked about team, and it's really interesting to, again, hear how important it is to have a team come around alongside you and support you and push you. I love how Eric talked about having legal counsel that specifically deals with mergers and acquisitions and selling your company, talking about maybe bringing in different resources specifically for the due diligence process, because let's face it, a lot of entrepreneurs' operational records and financial books are not set up for understanding the transaction and selling. So having additional resources come in to help specifically with that point is going to be really critical for you. And then also maybe engaging a broker, helping and understanding the value that a broker brings to the transaction, again, is reiterated on either side, whether it's the buy side or the sell side. And then the third thing that really stuck out to me, listening to Eric talk, was understanding what a private equity firm actually is looking for when they're acquiring your business. They're looking for that free cash flow. That's not just the EBITDA, which as a banker, I look at it and be able to say, okay, that's the amount of cash that can service the debt. But Eric said that it is the free cash flow after debt service and any type of capital expenditures, or there are things that you have to put back into the company in order to preserve or grow that cash flow and that bottom line. So understanding what a private equity partner does really look for and sees value in is so critical, and you should understand that on the front side. Well, as I said at the beginning, if you are not connected with either myself or Eric, I hope that you do that immediately on LinkedIn. Eric is such an amazing resource and is someone that, as you can now see, wants to push entrepreneurs forward. I hope that you enjoyed this episode as much as I enjoyed recording it with Eric, and I hope that you join us next week when we talk with Nathan Tyner, who is the broker. So we're actually going to shift away from buyers and sellers, and now we're going to come alongside to the people that support entrepreneurs. And we're going to be talking with Nathan Tyner, the founder of Greystone International, which is a boutique mergers and acquisitions firm. And he's going to talk about an acquisition or selling your business from the broker's perspective. Until then, this is Greg Martin, the Entrepreneur's Banker. I hope you have an amazing week.